Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in each and every week. Thanks very much for listening or watching, depending on where you are. We're on 5 great radio stations across a lot of the West and Southwest, and we're on 8 major podcasts, the Big 8 they call them, as well as YouTube. If you want to see the show, you want to taste it a little bit before you zoom in on every day, trying to find where we are, go to YouTube, Jeff Barton, the Mortgage Voice. That's the name of the show, and we have hundreds of shows there. We have a weekly show, and we also do it daily on LinkedIn as well as Facebook. We sometimes build in Twitter and Instagram. You know, hey, Daryl, I've tried Instagram a little bit more than I usually do.
Are you liking it?
You know, it's funny. People choose their social media, right? And they're real loyal to it. And I don't know what the loyalty is. It's kind of reminds me of football or baseball where, you pick your team and that's it. But a lot of people I know in different industries, a lot of design people, people in marketing, they love Instagram. There's something about it that, I don't know, they just love it. So I get a lot of feedback. I don't have a huge following on Instagram, but the feedback I do get is a lot. I mean, obviously with LinkedIn that we do every day, as well as Facebook that we do every day, I have followers on those and I do get feedback. But Instagram seems to have much more energized response behind it. What do you think?
I think that it's a velocity issue. I think that Instagram moves faster. Things go on, they go off. They're here, they're there, right?
Mm-hmm.
They're cartoony, they're serious.
Right.
I've always found that LinkedIn is expected to be a business-to-business
right.
portal, and people expect to see things. And on Facebook anymore, if you try to tell anybody or ask anybody to do something or go somewhere, they say, "Oh, this is not what this is for." You're trying to use this for commercial purposes. Well, you bet your butt I am.
Yeah, no, I agree. I've been lectured at more than one time, and I see it occasionally on LinkedIn when someone posts a political slant of one thing or another. You get 10 people in the trail, whatever they call it, the feed, that'll say, "Hey, this is a business site. Get that political stuff off here." It's funny, I think.
With Twitter, I think that's just sort of a swoop in, drop something, and get out of there, right? It's
yeah,
quick.
Yeah, another thing too, becoming much more familiar with how Twitter works. But on the other hand, there is so much attached in Twitter with either retweets or hashtags or other things that I'm just not educated enough to know what half that stuff is. Am I alone in that, or other people? Is that what
I think that anybody that says they understand it is probably spoofing.
Yeah, it's amazing.
There's a complexity factor to that, the hashtags and which ones are the hashtags you have to put on anything that you do to attract the type of people that you're trying to attract. And, I don't know. On Facebook, I've got 2 profiles, and each of them, have 1,000 or 5,000 followers, and I know less than half of them. But with Twitter, I think 100 people are following me, and I'm following maybe 100 myself, and it's just from a population standpoint, it's been a little slow.
Yeah, when we originally did the show, and we were just radio and it was just audio, and then we moved into some video, and now we're on a bunch of different ways by which you can see and hear us. It's interesting because the audience is so splintered in what they do and what they like. You almost have to hit all the bases. I told you I've been thinking about doing some TikTok stuff, but having been on that, a lot of it is just, pure entertainment. I laugh at most of it because it's hysterical. And it's very difficult to see a business application to it. But then again, I have somebody who does TikTok who is a person who helps people get work. And I think I've spoken about her.
Like a headhunter.
She's on LinkedIn a lot.
That's a good place for her to be.
No, she's more like, I'll help you by teaching you the skills you need in order to, I think is what it's called. And she does a great job. And she's talked about working TikTok. It's a different demographic too from what I get on LinkedIn. LinkedIn seems to be an incredibly serious type of, a person or somebody who wants to, peddle their wares. But outside of those parameters, you don't get a lot of humor, a lot of, whereas on Facebook, you can get anything. And it's just all of it's very, very interesting. And I think still developing. I don't think it's really set. I think really the way by which we communicate will become less cumbersome to, the device and more intuitive to the person. That's what I'd like to see. Because sometimes, like for instance, I want to do more, and I've talked to you about this, along the lines of a professional presentation whereby there's a better camera where we usually shoot if I'm at the studio with a better camera, and also to use of teleprompters and stuff like that. Problem is, technology wise, teleprompter and camera and syncage and recording requires way more than I got, so I have to go outside myself and find people like yourself and people who work in the technical area to be able to help. That's what I really would like to bring to what we do next year, because I think some parts of what we do is good and some parts could be better in terms of communication, what we're trying to communicate, and the ability to look as professional as possible while still being me, still being you.
I completely agree. Being on LinkedIn, I think you have to wear a sport coat to be on LinkedIn.
Well, luckily I wear my tie most days, even though it's askew. And so what do we got left in this segment here? About 5?
3 minutes and 21 seconds.
Okay, let me run through a couple of these items here. Okay, just some housekeeping, as well as what we normally do in this segment is to try to bring you up to speed on news of the day. So the housekeeping of the news of the day is 30-year fixed rate at 2.78, 15-year at 2.32. The FHA loan is at 2.25. The jumbo loan is at 3.11, and the 5/1 ARM is at 2.29. Now, all of these loans are near historic lows, and those out there thinking, oh man, it's going to get lower. Well, I don't think it's going to get below 2, and I've been saying I think next year we're going to see rates rise, and I think there's a number of reasons why we're going to see rates rise. We talked about it before, but let's just get through some more of this news. The 10-year is at 0.9, was at 0.94 trading today. Yesterday is at 0.95. We're still hovering near the 1-point range, but it's nearly a half a point above where it was 6 months ago. Now, what does that mean? Usually when the Treasury, the 10-year note rises, so does your borrowing rate, your mortgage rate. So that's something to keep an eye on. Freddie Mac and Fannie Mae, the GSEs, Freddie Mac bought $1 trillion in loans in 2020. Now you think about that. When I'm an old guy, right? I'm 65. When I was a kid, the word trillion was something you saw on cartoons. It was something that would be just, right? I mean,
yeah, Roger Rocket, or whatever.
Exactly right. I mean, these numbers didn't exist. Billion didn't exist. Now we're talking in terms of trillions. It's really amazing. But $1 trillion in loans in 1 year, that's an amazing number. $2.2 million in serious delinquencies. That's all these people who couldn't pay because they lost their jobs because of COVID. And by the way, those people who have lost their jobs and are having difficulty paying the rent or having difficulty paying the mortgage. Okay, when we first started out, it's about 6.5 million of these people couldn't pay their mortgage. Now that's been cut in about half, which is good, meaning that people are paying. But all these people who need help, 12 million people who might get evicted, it's just, I don't know what Congress is doing. Anyway, 9.5 million people have refied. That's last year. That's pretty good. 3 things in the COVID relief advice from Andy Walton at Black Knight. Keep people in their homes. Agree. Support with direct payments. Yes, more of it. And access to credit has to be. And you have to loosen those credit standards in order to do that. There'll be a lot of pushback from people who remember what happened at the 2008 recession, but there's got to be a way by which you can protect the consumer overall and get people loans, get them in houses. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for listening, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in and listening. And thanks very much if you're watching us on YouTube or some of the radio stations that carry our video feed. We're on 5 radio stations from Albuquerque up to Las Vegas, to the Inland Empire in Southern California, and up into the Tahoe area, both Vegas, Nevada and California. Again, thanks for listening. We're on the Big 8 podcasts, those Big 8 podcasts. Daryl, you have a list of those there handy?
I do, Jeff. It's Apple Podcast, Google Music Play, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, and the infamous YouTube.
Thank you. And on YouTube, Jeff Barton, the Mortgage Voice, go there. There are hundreds of shows, topical. We also do it daily on LinkedIn and Facebook called the Mortgage Minute. So if you'd like, you can always contact me. I'll hook you up and you can get your daily 1-2 minute blast of what's going on that day. We bring to the show, once again, Brent Gong from Malibu Funding, talk about what's going on in the mortgage arena locally, as well as what the trends might be coming up. Brent, how are you?
I'm good. Thank you, Jeff.
Okay, excellent. We were talking off air just about the difficulties of doing a service-related job, the mortgage business from home, especially if you've got distractions with home life, and a lot of people doing double duty, teaching as well as trying to earn a living. How's that going for you?
Yeah, it's pretty difficult. On top of that, just being in the mortgage industry, we're as busy as we've ever been.
Yep.
With the rates as low as they've been, and with the real estate market as hot as it is.
Yep.
It's a difficult task. I always feel like I'm behind a little bit, but it's important that we're, completing everything that we can, completing all the tasks that we can. It doesn't help to have 3 kids at home that you can't really get away from. So,
it's an amazing. And what you encapsulate is, I think, everybody who's still working. Who has the type of job where they can do it home is home, and it makes it difficult. The stress must be high. And I know the loan business real well, as you know. I mean, never been busy like this. Never. I mean, it's even 04, 05, 06 wasn't this busy.
Yeah, absolutely. It's just, I've been in the business almost 20 years, and
right.
It just seems like every couple of years, it's like, or every so often, it's like, wow, the rates have never been this low, and you just think it's not going to get any lower. Then if something happens, then the past couple of weeks, this is truly what seems like the floor, and it's just amazing that the rates have gone as low as they have, and everybody is jumping at the opportunity to refinance. I have a lot of customers who are looking to do construction, taking the money out while it's cheap, and everybody in the industry I know is as busy as we are as well.
Okay, so on the front end, we're talking about origination for those listening to the show, the interaction between the loan officer and the client. Let's talk a little about the back end. How is the volume affecting turn times and review of conditions and the ability to be able to act quickly? Because a lot of people in purchases, the seller wants to sell in 30 days. And so how are we dealing with that?
Well, luckily for us, since we have, we have our designated underwriting team with some of the lenders that we use, we're not seeing the delays that a lot of other lenders, especially retail lenders, are seeing. I mean, I've had quite a few buyers who were working with some of the retail banks, and they were told that they just can't meet a 30-day escrow. You know, they would need to request a 45-day escrow, and that just is so counterproductive right now, considering the fact that a lot of the listings locally here are going on the market and getting multiple listings within 3 days, 4 days, 5 days on the market.
Multiple offers, right? That's what you mean?
I'm sorry, Jeff?
Multiple offers, that's what they're getting?
Yeah, absolutely. And so right now I have real estate agents calling me with a pre-qualified borrower saying, "Well, we need to look more competitive. Can you do a 20-day escrow?" And
Right.
like, well, no, you can't really. I mean, lenders in general are taking longer because they're so busy, and just not a realistic turn time unless you're doing some type of alternative funding or cash. And I see all the listing agents. I'm sorry, all of the selling agents, the buyer's agents,
right,
for they have to make their offers more appetizing to the sellers because it's definitely the seller's market, and they're receiving multiple offers. And we're seeing houses selling for over asking price, and we're definitely seeing, like, just in the past 6 months, the values going up. I mean, sometimes it's hard to realize when the prices are increasing. You know, it takes some time, but right now it's really easy to see that the values are going up locally in the greater Los Angeles area. I'm sure in many places in the country right now.
Many places, every place. I see 10% is national average right now in a lot of different places, which is unsustainable. But at the same time, I guess the underlying value of the loan is so much better than it was in 08, just because the qualifications for the loans. Are you seeing the lenders actually tighten some of the requirements to get a loan, the underwriting standards, or are you seeing it loosening?
Well, because of Fannie Mae and Freddie Mac had a couple standards tightened because of COVID-19, but nothing significant. They're just very concerned that whether you're working or self-employed, that your income has not decreased, or you haven't been laid off, or your business hasn't decreased if you're self-employed in the past couple months. So prior to close, they're very careful. They're asking for another pay stub, another verification of employment to make sure you weren't laid off. For self-employed, they're asking for a profit and loss and recent months bank statements to prove that there's still business income. And that wasn't around before, but if somebody is legitimately, if their business is still running, then it's something they shouldn't have a problem providing. But that's about it. Nothing significant. I mean, we haven't seen. Well, I guess there was temporarily an increase in the credit score requirement for FHA, but then that went away.
Did that funding fee, the extra half point by Fannie Mae and Freddie Mac, did that impact you at all?
Well, yeah, absolutely. That affects the pricing. I mean,
right.
But okay, so as you're aware, many listeners may be aware that
it's the adverse funding fee is what they're adding on now since December 1st, right?
Correct. So they take, the government is taking 0.5%.
Right. They're taking your money, right? Exactly right.
Correct. So it definitely affects the refinance. It only applies to refinance, not to purchase.
Right.
But yeah, that probably, with the rates as low as they've been anyways, that has probably had little effect on the refi market. I mean, I'm sure it has had some, but very few probably aren't able to refinance because of that fee.
Okay, hey, Brent, I'm up against the clock here. About 30 seconds left. I wanted people to get a hold of you if they can and want to. Could you shout out a way by which they might be able to do that? Phone number, email, something?
Sure. Phone number there, code 818-585-7442. That's the best way to get a hold of me if you have any questions or about refinancing or purchasing.
Excellent. Brent, thank you very much for coming on. Brent is in Southern California, but does loans in, I think, 11, 12 states, right?
Correct.
Okay, excellent. Thanks very much for coming on again, Brent. I appreciate it.
Thank you, Jeff. Bye.
Thank you. That's Brent Gaughan from Malibu Funding. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. We're on each and every week, as you know, in our local area, whether it's in Southern California, whether it's in Albuquerque, New Mexico, Las Vegas, Nevada, or way up in Tahoe. All of these fine places and people. We're going to add a couple of affiliates this year. I just added a couple more people from around the country who does business with Malibu Funding. So I want to be able to also share with that locally. So we're looking for affiliates, and again, appreciate everybody who listens to the show. We give information, insight. We try to give some guidance, and obviously entertainment is at the top of our list. And bringing guests to the show who really know what they're talking about. Brenda Scott, who's been on the show several times, joins us now. She's a loan officer at Malibu Funding. And Brenda, first off, how are you? And Merry Christmas, Happy New Year.
I am great. Thank you, and Happy New Year to you. I can't wait till the year is over.
Oh my gosh. You know, I texted everybody I know the other day, and I think I hit you up. Basically, you know, let's throw some dirt on 20 and let's get 21 up and running pretty quick. That's the way I'm looking at it.
Yeah, we're on a good track right now. Got some good deals, got some good programs. Right. I mean, we even we have programs that are allowing borrowers to refinance now, even though they had a forbearance. So now, if they were in a forbearance and now out of a forbearance, at least for 3 months, they can do a refi to lower their payment.
Now, tell me, okay, let's walk through this slowly. So I had a job, lost a job in March, got an opportunity not to pay my mortgage, which is what forbearance is. And now, all this time later, I have begun a new job and started paying. How does the lender look at a borrower like me? How do they see it as a no problem because Fannie Mae will buy the loan, or do they?
If they've if they've out of that forbearance for 3 months, it's good. We have to prove that they went into the forbearance, they're now out of the forbearance, and they have been current.
Oh, they have to be current. So they pay. Okay.
And they can get cash out.
Wow, that's pretty good. Okay. So now is the rate higher, or is it all underwritten as if, the forbearance never existed?
No, the rate is still based on their FICO scores. If they got good FICO score. I have one, I think his mid score is like 658.
Okay.
So the rate that he has is 2.875.
On a 30-year fixed cash out?
Yes.
Well, there's nothing wrong with that. That's for sure.
Yeah.
Wow.
Yeah, I mean, you can't, of course, you can't lock these rates right now because, man, I'm having a hard time with appraisals. Appraisals are taking so much longer now.
Right.
So you can't really lock that rate until you know you're getting that appraisal.
Absolutely right. And are these on purchases? Or
doing some, which is good if you want to lock it. They're giving you the 60-day pricing, same as 45-day pricing. So it's still not bad.
Oh, okay, that's okay. As long as they're giving you the time and able to lock in when and hold the lock, 60-day pricing's okay. Nothing wrong with that.
Exactly.
Yeah.
Otherwise, if you lock too soon and that lock expires, then it costs more money.
Now, we've been doing this show, you and I, for several years, and every time we come on, we talk about issues and problems. Let's switch gears just a little and say, well, what are some of the good things that are happening as a result of COVID? Business is up, right? I mean, everybody's got more business than they had.
Rates are good.
Right.
The guidelines are good. It's just,
Right.
it's just taking them a little longer to do it. I mean, lenders are doing some really good things as long as you can document that file and still get a really good interest rate. So that's good. I'm happy about that.
Yeah, I agree. All of those things, all the four things that you said are great. And for people who can take advantage of it, they're lucky, because there's a lot of people out there who can't take advantage of it because they lost their job through no fault of their own. And these people need help. I think the economy will be better off if we get more stimulus money to them. Now, we call it stimulus money, and we all know what it is. It's selling debt on the market, on the open market, in order to be able to fund whatever it is that they want to do. Right now, that's kind of what they're doing. Or they just print more money. I don't know how the long-term effects of all of that are, but short-term, you know, those people, and I know people who are in those positions, and it's not an easy position to be in.
Just be patient. You know, you just got to tell your clients, you know, you can't do this in 30 days anymore. You know, you just really can't. I mean, that package got to be totally completed from A to Z with the appraisal, everything. Other than that, Jeff, I think this is a good market. This is a good time to buy, even though I know it's a seller's market. But there's a lot of good programs. FHA has reduced their FICO score requirements. That Home Ready program is an excellent program for first-time home buyers. So there's some good things happening. People need to take advantage of it.
I agree 100%. Okay, prognostications. Now, I have said on this show, even today, I think that rates will rise, and I think they will rise for a number of different reasons, maybe none of them having to do with the current, the way it is, whether it's the Fed buying mortgage-backed securities and treasuries, or whether it's, you know, the 10-year bonds still selling below 1 point, although that has really, you know, shot up. It was selling at a 0.5 point. Now it's almost to a point. But I think rates will rise because the market's got to slow down, and that's the only way to do it. I've seen lenders individually do it. What are your thoughts on that?
I agree. That stimulus package, it didn't come free. They got to get that money from somewhere. So I'm assuming, you know, hopefully the first of the year they're going to crank interest rates up a little bit. You know, I agree with you. They're going to go up.
Yeah, I think at the end of next year we'll see probably a point higher than it is now. If you've got FHA at 2.25, you're going to see 3.25, which is still a smoking rate. Even when you add in the monthly MIP, you know, you're going to get, you know, right around 4%, a little bit more in terms of a monthly, which is still an unheard of rate 5 years ago, right? I mean, even
it's an excellent time to buy and to refinance. Excellent.
Now,
if you got those HELOC loans, now it's time for you to get rid of those HELOC loans.
You got that right. I mean, unless, now that's an interesting point. Let's say somebody has a HELOC and they want to do a refi. What do they have to do in order to do that refi with that HELOC? Do they have to get rid of it? Can they subordinate? How do they deal with that?
Well, lenders are doing subordination. I have 2 in the system now that we're refinancing cash out, and we have to request a subordination package from the HELOC lender.
Right.
So you have to get that loan approved and then submit that approval along with what their other requirements are, and they'll approve your subordination agreement.
I see. And that adds time to the loan, right? Obviously, that adds 3 to 5 days, easy.
Oh, easy.
Okay. Hey, Brenda, could you tell people how to get a hold of a terrific loan officer who works in Southern California? That'd be you?
Trying to do a subordination.
Oh, Okay. Shout out your phone number, will you, Brenda, for people to get a hold of you?
Yes. Call me 562-500-2400.
And obviously, not only can you help them in their loan needs, you probably can advise them on their real estate purchases as well.
Oh, that would be fantastic. Yes, I can. Yes, I can.
Okay, excellent. Brenda, thanks very much for coming on the show. Great discussion. And, let's be optimistic. This year is going to be a good year, and we're going to help a lot of people.
Oh, I believe it.
Yep.
I believe it. Thank you so much.
Thank you. And that's Brenda Scott, who works for Malibu Funding, Inc. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in, for listening to us each and every week. Bring you information about loans, real estate, the market, the state of the market, future state of the market, everything else in between. Today, we're going to concentrate somewhat in this interview on programs from a new lender that we've never had on the show, but we've had Wendy on the show several times, several million times. No, I'm just kidding. Anyway, Wendy Van Wessel from Kind Lending is joining us again. Wendy, thank you very much.
You're welcome, Jeff. Thank you, and almost Happy New Year.
Yes, it is almost Happy New Year, and by the time the show airs, it'll be New Year's past. So that's okay, and I do appreciate, your patience with us, as well as your loyalty and your drive to get better and better. Tell us why the move to Kind, what Kind is all about, and how that's going to solve some problems for both the brokerage community and the borrowers out there.
I worked for the last lender for over 11 years, and it just was time for me to find, and I love Glenn Stearns. Kind Lending is Glenn Stearns' new company. Glenn Stearns is a man who's known as the gentleman of the business. He knows what he's doing. He's been doing it for over 30 years. I've worked with him for 11 plus years. And he wanted to start this company, taking over the best of the best and giving the best experience for the brokers and also the borrowers. He wants to, what I said to you earlier, uncommoditize the business, meaning that it's more boutique feel, that you are an individual and every loan is important. And I have seen the operations team jump over each other to try and help push files along, get answers quickly, and our turn times are 72 hours, including self-employed borrowers. Some other lenders have gotten that 780 FICO out there, or that it's 21 days for an approval. We are not like that, and our rates are really good. So that made me make the jump.
Okay, there's only one way to do that, right? Now in terms of making it more personalized approach, that usually says to me that you hand underwrite some of the files. Yet at the same time, to do volume and to turn quickly, you have to be technology driven. How are you guys solving the dilemma that I see, or maybe there is no dilemma and you've got the answer?
I think that technology is one of the main things on Glenn's plate too, and I saw that. Our website is very easy to navigate. It'll be even easier in the next couple of weeks. Everything is in one place. To order appraisals, it's very simple. For the brokers, for the borrowers, it means that there are underwriters looking to fund loans, and that the brokers can talk directly with the underwriters and see the best way to position the loan so that it can be sold, obviously, on the secondary market. If you want to ask about risk, there's Fannie, Freddie, and FHA or HUD that have guidelines on how loans perform, whether they default or not. So they have their guidelines, and we adhere to those, but we don't have a lot of overlays on those.
Yeah, no, you've said a lot of things there that you and I understand. Some of them are, easily understood by the consumer, but some aren't. Overlays. Describe what an overlay is and how other lenders are using that in order to boost their bottom line.
There is an overlay, for example, for self-employed borrowers with the COVID virus that's going on, and a lot of self-employed businesses heavily impacted. It means that they're looking for 3 months worth of bank statements to show the income coming in that's consistent with what was on last year's taxes, or what they're using for that debt to income ratio, meaning that I make $1,000 and that I have $450 worth of expenses, right? So it's a 45% debt to income ratio. That meaning that you have 55% of your income that's left over. That's what they're looking for nowadays. It's 45. It used to be 55, and sometimes. So you go to automated underwriting systems from those government agencies, and if they give you an AU automated underwriting system approval, we'll follow that. A lot of places will have overlays that say, no, we won't go over 45%, even if you have an underwriting systems approval at 48%.
Well, they will, but it'll cost you more money. Isn't that what they really do? Isn't it about boosting bottom line here?
A lot of them aren't even going that high. I know that they won't go over 50% on FHA loans. I know that there's a lender out there that for self-employed borrowers needs a 780 FICO and needs 21 days to underwrite the loan because they want to get those easy loans in and out the door, and self-employed borrowers are usually more time-consuming.
Okay, so program-wise, what is Kind offering? And obviously you're describing yourself as a boutique, a more personalized approach, less overlays, quicker turn times. Technology looks to be something that you're going to be, I guess, continuing to make improvements on to get, quicker turn times. But what are some of the programs?
That's one of the things that they're pushing, yes. Already it's easier than a lot of systems that I've seen. I think we do very well with Fannie Freddie. Conforming and high balance. Our government pricing is on fire right now with FHA and VA. Shortly, we will get those piggyback seconds, which allows
that's good.
Cash out hits or higher rates on the first, and you can do the cash out on the second, which is 10-year interest only, and jumbos, and then the banker stuff too. But I don't know if the borrowers want to know about that.
Now, you said that FHA on fire. I was looking in general. I mean, the average FHA loan is about 2.25%, which is unbelievable. That's really unbelievable. You're saying your rates are comparable?
Well, let me look at today's rate sheet. Today's rate sheet is showing 2.25 for per 2.99 back.
Wow, and the get backs, that helps with closing costs for the borrower, right? That's what you're talking about there.
Correct. 2.375 will show over almost a point. So if you have a $500,000 loan, you have $5,000 towards closing costs.
Well, that's now, and that can be used to, in what respect? When you say closing costs, what does that mean to a borrower?
That can be the lender paid comp. That can be your taxes and insurance if you want it. That can be escrow, title. All those things can be paid for with what we call yield spread premium. It's also called rebate. They like to have 3 different names for things in this industry. I have no idea.
I don't know why. Yes, that's true. They do. Everything's got 3 names to it, and it's all abbreviated, and it sounds like gobbledygook, really, to most people.
And you know what I like about Glenn, too? If I ever want him to or need him to, he's more than willing and happy to go out to a broker's office. If you haven't seen him in Undercover Billionaire yet, you can see what kind of man he is. That wants to do things to the industry, wants to rival some of the big boys out there, UWM, in the next couple of years, and I think that we can do it.
UWM, they're going public. It's supposed to happen in January, and Rocket Mortgage already has gone public. Do you think that this push to cash out, which is what I think this is, I mean, initially, I guess it's used to beef up staff or to expand programs in a certain area, but I don't know if it's good for the consumer. I don't know if that's the way you're heading, your company is heading. I understand the want to do it by owners of companies that, obviously want to monetize what they have in ownership. But at the same time, I'm not sure it's the best for consumer. What are your thoughts on that?
Why do they want to do that? Because when you go public, then you have to answer to people just like another company had to answer to a big person out there, the Blackstone that bought them. When you do, you have to make a profit. So you're not as, you have to pay more people, you have to make a certain kind of profit, and it limits you. I think that going public limits you as a lender.
Well, I think what happens in a downturn in the economy, and because since whenever, World War II, let's say, every 7 to 10 years, we have a recession. Now we're in one right now, which was sort of artificially made. It hasn't affected our business, but it will. It's coming. We all know it's coming. The housing market will go down. The mortgage rates will go up. What happens to a company who is beholden to shareholders and profit margin? How are they going to be able to service when they're looking at a downturn in the economy and borrowers who might not be able to pay? Are they going to be as ready as a company like Kind Lending to be able to lend in those circumstances, or are they going to be beholden to the shareholders?
That's exactly my point. I don't see the benefit of becoming public other than
Right.
monetizing your assets, right? To
Right.
pull out your assets. I don't
Right.
see to it. I would rather have the ability to make my own rates and don't fool yourself. Lenders are doing great business. They're very busy right now. Rates are at an all-time low. So those people out there that can and are smart enough to make their 3 months worth of bank statements look good when they're self-employed borrower and get their saving their $500-700 a month and getting their homes refinanced, and the purchases out there will be around for a while because those rates are going to stay low, at least for the first half of 2021. Don't you think so?
I do. And we're up against the clock, so I got to say goodbye, but I want to have you back soon. Can you tell people how to get a hold of you directly if they want to talk about loans with Kind Lending?
Sure, anytime. You can email me at wvanwessel, WVANWESSEL, at kindlending.com. And I look forward to hearing from you, and you have a wonderful day.
Wendy, thanks very much. Always a great discussion, and we always end on a I want to do more. So that's a good thing. Thank you very much.
Thank you for having me.
Okay, bye. I'm Jeff Barton, your voice in the mortgage industry. That was Wendy Van Wessel from Kind Lending, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in, for listening. Each and every week, we bring to you some, solutions to problems out there. Right now, there are not a lot of problems, except there's no inventory in the real estate market. Rates are great. Rates are going to be great for a while, although I do see some headwinds second quarter next year. We've talked about it before on the show, but I bring back to the show Orion Lending. A guy from Orion Lending hasn't been on the show, and I'm very grateful that he does come on, Justin Simper. And Justin, thank you very much. He's an account executive over there, for coming on the show. And how are you doing?
I'm doing good, Jeff. How are you doing?
We had children home for a long time. They're older children, but they came home for a while. They were having some difficulties during COVID. Now they're back to wherever they are. But other than that, I guess it's okay. It is what it is, I guess, is how they say it, or how the president said it.
That's all right. It is. I recently recovered from COVID myself.
Oh, I'm sorry to hear that. Are you okay?
Yeah, no, I'm good. I'm just tired. It carries with me, man. It's been about a month. I'm just tired. It is what it is, though, like you said.
Right. Okay. Well, I'll try not to tax you by throwing you a few softballs. Tell me a little bit about Orion's programs, how you're helping people in this market, what kind of loans you're doing today.
Well, primarily, like for me as an AE and growing up as an Army brat, like I really focus on VA, and pricing wise, Orion is probably the number 1 or 2 lender in the United States for pricing on VA. So, it does make for a lot of VA business. So I would say I specialize in VA loans, really. But government loans, FHA, USDA, we do a lot of that. And our jumbo pricing that we rolled out about 6 weeks ago is phenomenal. And we're, beating lenders like Chase and Wells and all the big boys. So I get a lot of that business too.
Okay, let's talk a little bit about both VA and jumbo. VA first. Explain to the listener the requirements for someone who is a veteran in order to obviously get a VA loan, 100% guaranteed. What's the funding fee? How does the process work? Could you just walk us through a little bit on that?
Yeah, I mean, basically the veteran would want to get the certificate of eligibility, or the loan officer or the lender can pull it, and that's going to tell you, what they're eligible for. And so the certificate of eligibility from VA is going to state, whether or not they're eligible for 100% financing. Now, assuming most of the borrowers that I work with, they have not used their entitlement yet, so most of the time, it's 100% financing, and they're paying off the loan, whether it's cash out or a streamline, which would be an IRRRL, that is to over 100% on an IRRRL, but on a cash out you can go up to 100%. Now, the VA funding fee, I'll get into it in a second on the percentages, but that is the only, really, that's VA's version of the mortgage insurance, but there is no monthly mortgage insurance for a VA loan. When you combine that with the rates that they're getting, which are in the low twos typically, that's something that's just really enticing. And I will say, like Orion Lending, there's actually no cap on a VA loan. So I get veteran doctors buying a $2 million home, going 100% financing with no mortgage insurance. I mean, it's you can't beat that with
you can't.
No. So yeah, it's just to me, it's the best loan out there. If you're a veteran, you need to take advantage of that and get your VA loan, because it's just amazing. And I do a lot of harder to do loans for VA. Like, I've done veteran with buying with their daughter and the boyfriend's dad, right? So I've done all the weird loans, but yeah, I mean, the funding fee, for the VA loans is, I'm actually just pulling it up because it's ever changing, but so a first use funding fee to 100% financing is 2.3%. And so what VA does is they tack that on to the top of the loan. And, so if you're buying for $100,000, your actual loan amount's going to be $102,300. So, but for the funding fee itself, let me pull this up. Okay, so if you're going to go 95% LTV first time user, it's 1.65%, and 90% lower is 1.4%. So, cash out loans, or after your first use, you're going to be at 3.6% if you're at 95 or higher, but 5% or more, it drops down a lot to 1.65% of the loan amount.
I see. So there are a lot of choices to be able to make based on your situation, obviously cash on hand.
Oh, yeah. Yeah, definitely. Mm-hmm. And
okay.
Like I said, there's no maximum, really. You could buy a $5 million house, VA 100% financing, and you're not going to get a better rate anywhere, in the world other than VA, So, yeah, I mean, it's just, probably though, my favorite VA loan, I have to say, is probably the IRRRL, which is the interest rate reduction loan.
Of course.
And that's just taking a veteran who's not wanting cash, but wants to save money. And, we close those loans really fast. There's no income documentation or asset documentation needed on those files. So they just fly right through. But yeah, the IRRRLs are just amazing. I mean, the funding fee on a VA IRRRL is 0.5. So
I see. Right. Hey, let's switch a little bit and go up to jumbo, because we have about 3 minutes left, and I want to hit on that end of the spectrum as well. Tell us about your competitive rates, some of the underwriting guidelines to qualify for the loan.
Yeah, I mean, so our jumbo is super, super simple. I mean, it's basically you're going to run the automated underwriting system, and it's going to return a approved ineligible. And so basically what that means is it's approving the loan, but it's ineligible due to the loan amount, and that's based on Fannie Mae underwriting guidelines. But there's only a few overlays, and so I have to have reserves, right? So you need reserves for a jumbo loan regardless of what the use says. Loan amount million and lower is 6 months reserve, and loan amounts over $1 million are 9 months, which is still very, very limited, as far as the market goes. That's pretty good. And then, DTI wise, which is the debt to income, and the ratio is 43% for jumbo. And so that's basically the only overlays that they're going to have. But, the rates in themselves are just, they're amazing. And so I'm actually going to pull up the rate sheet real quick, but let's see, rates, bang. But anyway, yeah, I mean, you're talking, getting rates in the mid to high twos, and being able to get a jumbo loan is just not something that's
No, it's unbelievable. I mean, you say they're overlays, but most jumbo loans are going to require some pretty stringent look under the hood. So this aren't necessarily the most cumbersome in terms of any kind of a restriction on getting the loan. I think it's pretty liberal.
Oh yeah, it is, and that's why in the first 6 weeks of rolling it out, I mean, I literally have probably 150 submissions in that short time period, and that's not really marketing it. It's just brokers going on Loan Sifter and looking at the rate, going, "Is that real?"
Right.
Yeah, definitely. Jumbo is easy, and in the jumbo world, a lot of lenders are not fully delegated to underwrite the file, so they have to go out. We're fully delegated, so we don't need to send the loans anywhere. It's pretty standard, straightforward, standard turn time, nothing crazy, So yeah.
Hey, Justin, we're up against the clock here. I'd love to have you shout out your phone number or a way by people can get a hold of you if they want to talk to you about either one of these loans or some other great products at Orion.
Yeah, sure. Yeah, my phone number is 949 area code. It is 310-3750. And my email is jsimpers, my last name, and that's S-I-M as in Mary, P as in Paul, E-R-S, @orionlending.com.
Justin, thank you very much for doing this. I appreciate it. Want to have you back. Great. And I love your particular presence online as well. Good job.
Yeah, thanks, Jeff. I appreciate it. You guys have a good day.
And you have a good day, too. I'm Jeff Barton, your voice in the mortgage industry. We'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.